Welcome to the Deep Dive, where we try to cut through the noise, and unlock the real stories behind complex information. Today, we're peeling back the layers on Honeywell, ticker HON. It's a company that's, always seems to be reinventing itself, and right now it's at the center of a really fascinating debate. Okay, let's unpack this a bit. We've got two really different analyses on Honeywell. One is strongly bullish, painting a great picture. The other one, it's raising some, frankly, pretty serious red flags. So our mission today is to pull out the most important nuggets from both sides to help you understand what might really be going on without, feeling totally overwhelmed. Think of us as your guides through all this info, just distilling it down.
Yeah, and what's really fascinating here is exactly that, how two different sets of eyes, two different analyses can look at the exact same company and just arrive at such, remarkably different conclusions. It's quite something. And just a reminder, as always, this deep dive is purely for your education and hopefully entertainment. It's here to help you understand the different arguments, the different perspectives out there. It is absolutely not financial advice. Think of it more as a journey to broaden your own knowledge base.
All right, the stage is set then. Let's dive into what has that bullish report so convinced about Honeywell's potential. It paints a really compelling picture, actually. It describes Honeywell as a, and I'm quoting here, diversified industrial technology leader being reorganized around three secular megatrends. Those are automation, the future of aviation, and energy transition. Pretty big themes.
Huge things. And they're not just hopeful, like you said. The report gives a firm BUY recommendation, and it comes with high conviction and a specific 12-month price target of $265.
Wow, $265. So doing the math, that implies, about 19% upside from its close on July 29, 2025, which was $221.72.
Exactly, around 19%. So yeah, that's a pretty bold declaration, as you put it.
Okay, so what's underpinning that confidence? What's the core driver here?
Well, the core of that optimism, according to the report, stems from Honeywell's strategic reshaping. That's the term they use. They're not just tweaking things around the edges. This is a major transformation they're undertaking. The plan is concrete. Spin off Advanced Materials by Q4 2025. So pretty soon. And then spin off Aerospace by the second half of 2026, creating two completely separate publicly traded companies.
Okay, spinning off major divisions. What's the bullish rationale behind that? Why would that be good?
Right. The bullish rationale is pretty straightforward. It's expected to, quote, crystallize value and narrow the conglomerate discount.
Conglomerate discount. I've heard that term before, but can you break that down for us a bit more? What does that actually mean?
Sure thing. So imagine a big company that does lots of different things, like Honeywell. Sometimes the market struggles to value all those different pieces accurately when they're bundled together. The conglomerate discount basically means the market values the whole company at less than what you might get if you added up the value of each individual business if it were standalone.
Ah, okay. So the sum of the parts is potentially worth more than the whole in the market's eyes.
Exactly. So by spinning these divisions off, the idea is to crystallize that value, make the true worth of each part clearer, more visible. And the hope is that this leads to multiple expansion, which means each new, more focused company might get valued at a higher earnings multiple by the market because their story is simpler and clearer. We've seen this kind of playbook before, right? Think about GE spinning off GE Vernova, similar logic.
Yeah. Right. So it's like decluttering the corporate house to show off the valuable furniture inside, hoping each piece gets appraised higher on its own.
Makes sense.
Okay, so if that's the strategy, let's dig into the specific growth engines the bullish report is counting on. First up, Aerospace Technologies. How's that looking?
Looking very strong, according to this report. Q2 2025 sales were impressive, $4.31 billion. And that came with 6% organic growth.
6% organic growth in aerospace, that's healthy.
It really is. The report points to a strong aerospace supercycle happening right now, plus really good resilience in the aftermarket, parts and services. In fact, their aerospace backlog was up a solid 16% year over year in Q2 2025.
15% backlog growth. Wow.
Yeah. And what's really key here, the report emphasizes the sticky high-margin parts and services revenue. That comes from Honeywell's huge installed base of equipment already out there.
Sticky revenue. That sounds like a good thing. It's like a built-in advantage.
Absolutely crucial. It's like a strategic moat, really. It means even if new plane or equipment orders fluctuate, Honeywell keeps generating substantial, reliable cash flow from servicing the stuff already flying. High margins, too. It gives them a resilience that, maybe companies just selling new hardware don't quite have.
Okay, aerospace sounds like a core strength.
Yeah.
What about the other areas? Industrial automation.
Right. Industrial automation. The report highlights this too. Now, Q2 2025 sales were $2.38 billion, and organic growth was flat there.
Flat.
They're flat. But, and this is important, margins actually expanded, went up by 20 basis points. It's small, but it shows they're improving efficiency even without top-line growth. That's a win for profitability. Plus, they've been active with acquisitions. They bought Sundyne for $2.2 billion, Johnson Matthey's Catalyst Technologies for $1.8 billion.
So investing even if growth is flat.
Exactly. The strategy seems to be deepening their franchises in high-margin areas, expanding their reach. And there's this interesting note about upside optionality in warehouse automation. The idea is, as e-commerce volumes get back to normal, that sector could really pick up again for them, so potential future growth hiding there.
Okay, so strengthening the core, looking for future triggers. What about the third leg, energy transition, or their energy and sustainability solutions segment?
Yeah, that's another area the bulls are pointing to. Q2 2025 sales were $1.84 billion, and again, strong organic growth there, 6%. The report really stresses their position with UOP catalysts and CCS solutions. CCS is carbon capture and storage. Apparently, these underpin a sustainability backlog worth over $3 billion.
Over $3 billion just in sustainability-related backlog.
That's what the report says. UOP catalysts are vital in refining and petrochemicals, and CCS is obviously huge for industries trying to decarbonize. So Honeywell is right in the mix. They also mention landing a big LNG turbo expander deal for the North American export build-out. So they seem really positioned in that whole global push for cleaner energy and sustainable industry.
Okay, so operationally, the picture looks, well, pretty positive from this bullish angle. Strong aerospace, strategic moves in automation, big potential in energy transition. Are the financials backing this up?
They are, according to this report. The numbers seem to reinforce that optimism. You've got consistent revenue growth, went from about $35.5 billion in 2022 up to nearly $40 billion. 39.99B for the trailing 12 months ending mid-2025. Adjusted EPS, that's earnings per share, is also trending up. It was $9.16 back in 2022, and the guidance for the full fiscal year 2025 is now $10.45 to $10.65.
So earnings are expected to grow. What about cash? Cash flow is king, right?
Absolutely, and their free cash flow, or FCF, guidance for FY25 looks robust. They're projecting $5.4 billion to $5.8 billion. And that cash isn't just piling up. They're using it for accelerating share repurchases. Over $1.7 billion bought back in Q2 2025 alone. Plus, they have a history of returning cash via dividends, a 5% dividend CGR over the last 13 years.
Okay, hold on. CGR, can you quickly explain that?
Sure. TGR is compound annual growth rate. It basically averages out the annual growth rate of something, like the dividend, over several years. So a 5% dividend CGR over 13 years means they've consistently raised their dividend payout to shareholders at a pretty healthy average rate for over a decade.
Got it. So consistent dividend growth. That suggests confidence from management.
It certainly suggests a management team focused on returning value to shareholders. Yeah, and they credit their Accelerator operating system. That's their internal process, apparently, for driving growth and keeping those margins protected.
Okay, so strong operations, growing earnings, solid cash flow being returned to shareholders. From this bullish view, it sounds pretty good. How did the market see it? What about valuation?
Well, that's another key part of the bullish argument. Honeywell trades at about 25 times its estimated FY25 earnings per share. And the bullish report argues that this is actually a discount to its 5-year average, despite, having a record backlog, raising earnings guidance, and doing these portfolio unlocks with the spinoffs.
A discount. Compared to who?
Compared to its own history and also its peers. The report specifically notes that HON trades at 25.1x forward EPS, while similar multi-industry companies, especially those that have announced spins, are trading at a median multiple of maybe 27, 28x.
So the argument is there's room for the stock price to catch up as the market appreciates the changes.
That's exactly the idea. Plus, you have very high institutional ownership, 81%. The top 25 holders control half the stock. That usually signals confidence from big, sophisticated investors. Analyst momentum looks positive, too. 9 price target raises recently. The average target, according to FactSet, is around $252. And interestingly, there's an activist investor involved, Elliott Management. They have a huge stake, over $5 billion.
An activist. Usually that makes management nervous. But the bullish report sees this as good.
Yeah, kind of counterintuitive, right? But the view here is that Elliott is actually supportive of the spinoff strategy and is pushing for continued cost discipline. So rather than being a problem, they're seen as another force, making sure management executes on unlocking that shareholder value.
Okay, so that lays out the optimistic blueprint pretty clearly. Strategic shifts, strong operations, good financials, supportive investors. Sounds compelling,
Yeah.
but, and there's always a but, isn't there? Every strategy has risks. And this is where it gets really interesting, because the bearish report takes a very different view, focusing on what it sees as a major vulnerability. While that bullish picture is strong, the bears raise serious flags. No investment is risk-free, and one concern that really jumps out from the bearish side relates to Honeywell's finances, specifically its debt.
Exactly. If we connect this to the bigger picture they're painting, the bearish report highlights what they call, and this sounds dramatic, dangerous leverage expansion that threatens financial stability, unquote.
Right.
And they don't just say it, they provide some pretty specific, maybe even alarming figures.
Okay, what are the numbers?
According to their analysis, Honeywell's total debt, well, it's skyrocketed, up 49.6% in just 1 year, from $21.5 billion in 2023 to $32.2 billion in 2024.
Wow, nearly a 50% jump in total debt in a year.
Yeah,
That's a lot.
it is. And it gets worse if you look at net debt that's total debt minus cash. That surged even more, from $13.6 billion to $21.7 billion. That's a 59% increase, again, in a single year. This rapid borrowing also pushed their debt-to-equity ratio up from 1.36 in 2023 to 1.73 in 2024, which indicates, significantly more leverage relative to the company's equity base.
Those are some stark numbers. A rapid, significant shift in the debt profile. How does the bearish report interpret why this happened and what the danger is?
Right. Their interpretation is that this debt wasn't necessarily taken on for, let's say, universally great reasons. They argue it primarily funded acquisitions of questionable strategic value.
Yep.
They specifically mentioned the Bombardier partnership as an example, claiming these deals actually immediately pressured margins, meaning they hurt profitability instead of helping it, at least initially.
So the accusation is they borrowed heavily for acquisitions that maybe weren't the best moves.
That's the bearish take. They see it as taking on excessive leverage, especially for a big industrial company that's naturally exposed to economic cycles. From this perspective, this pileup of debt isn't just a number. It's seen as a fundamental weakness, something that could potentially jeopardize the company's financial stability and its ability to actually pull off these big strategic spinoffs successfully.
Okay, so a direct conflict there.
Yeah.
The bulls see the strategy and the cash flow. The bears see the debt used to get there and worry about the foundation. It's worth mentioning, right? The bullish report does have a counter-argument on the debt.
It does, yes. The bullish side would point to that strong free cash flow, over $5 billion a year, and argue that it allows Honeywell to delever, to pay down that debt relatively quickly. They also note that there aren't any major debt repayments or maturities due until 2027, so they have some breathing room. But yeah, the severity and the speed of that debt increase is clearly the specific point, the major red flag that the bearish analysis really hammers home. It highlights that tension, doesn't it, between making ambitious strategic moves and keeping your financial house in solid order.
Absolutely. So what does this all mean for you, our listener, trying to make sense of Honeywell? We've taken this deep dive looking mainly through that optimistic lens today, the strategic changes, the growth drivers in aerospace, automation, energy. But we've also shown a spotlight on a really significant financial concern raised by the bears, that rapid, dramatic rise in debt. Understanding both sides, the potential rewards and the critical risks, is just so key to being truly well-informed, wouldn't you say?
Couldn't agree more. That's precisely the point. This deep dive, like all of them, is about broadening your knowledge, sparking your curiosity. It's definitely not investment advice. The real goal is to give you different lenses, different ways to look at these complex situations, and to help you understand the arguments analysts are making out there. Always remember to do your own research, look at multiple viewpoints, and just think critically about the information you encounter.
Sound advice. So here's a final thought to leave you with. As Honeywell navigates this really complex three-way split, aiming for growth in these critical sectors, how do you think a company successfully balances those big, ambitious strategic moves with the need to maintain a strong financial foundation? Especially when some analysts see that rapid debt increase as a major red flag. We genuinely love to hear your thoughts on this. If you're listening, jump into the comments and share your opinion. Do you see Honeywell's debt as maybe a temporary issue, something their strong cash flow can handle as the bulls suggest? Or do you view it as a more fundamental weakness, a potential risk that could derail their plans, like the bears worry? Thank you so much for joining us on this deep dive. We really hope this exploration gave you some valuable insights, maybe some surprising facts to chew on. Until next time, keep digging.